Still in East Africa, Moody's has cut Kenya's sovereign rating even deeper into junk territory, and it's citing the country's inability to contain its debt burden. Kenya is now rated at CAA1 from B3, and this comes after the Kenyan president, William Ruto, was compelled to make some spending cuts rather than increase taxes following mass protests that have left dozens dead in the last few weeks. The initial measures were intended to raise an additional $2.7 billion in new tax revenue, which the authorities say would have helped to reduce the fiscal deficit and the amount of borrowing needed by the country. Moody's, however, is noting that the spending cuts, while they will certainly help to narrow the fiscal deficit if implemented, they would essentially reduce Kenya's deficit at a much slower pace than previously assumed, effectively keeping Kenya's debt affordability weaker for longer. The credit rating agency has affirmed a negative outlook for Kenya, saying that these larger deficits will push up borrowing requirements and ultimately increase the government's liquidity risks. Churchill Ogutu is an economist at IC Group. When we spoke a little earlier today about this downgrade, I started our conversation by asking him what this implies for Kenya's ability to take on new debt.
Obviously, it complicates the raising of commercial debt, that is syndicated loans, which tends to be on variable interest rates, and also the Eurobonds. As to the concessional loans, now I'm looking at the multilateral and the bilateral. I may not see a short-term impact at the moment because on the bilateral side, these are project loans which already had been hammered out for a number of years. So it's just a matter of now bringing basically financing the underlying projects by some of these monies.
But this doesn't have any ramifications on the local debt market, does it? Because, I mean, debt prices in the domestic market have already been pretty high. We're looking at, I believe, an average of 17% for Treasury bonds that were issued in the last fiscal year. T-bill rates are not far off from that, about 100 or so basis points below it, around 15-16%. So the domestic market, in one sense, has already sort of priced this in.
You can say it was already priced in. Remember, this is like the second downgrade by Moody's in 14 months. And that's right about the time we saw T-bills galloping to double-digit levels from below 9% levels. And also the Treasury bonds to the average of 17% that you mentioned. So sort of you can say that the domestic market has priced in. Right now, actually looking at the macroeconomic fundamentals, I've seen the currency has turned. I've seen that even for the good, that is, I've seen that inflation has also come lower, below the target midpoint 5% range. So right now, actually, the market is sort of looking at guidance from the monetary policy as to be able to see as to how the local rates will now be able to come lower.
Let's focus on the external side of things between now and 2028, 2029, because there's another series of bunching risks, right, that come in between now and then, with a lot of our debt, our external facing debt coming due between that 3 or 4 year window, isn't there?
Absolutely. This year we're looking at $2.9 billion coming due, and next year we're looking at $3.9 billion, and then FY27 slightly at $3.9 billion, and then galloping to $4.9 billion at FY 2028. Interest payments is quite stable to $2 billion. But if you look at now the drivers of the higher maturities, for FY 2028, you know that that outsized Eurobond, $1 billion coming due. Between this financial year to fiscal year ending June 2027, we'll be repaying $300 million apiece for the Eurobond maturing in 2027. So that is amortizing. But in between, the other large component is now the lumpy payments that we are paying to Exim Bank of China to the tune of $850 million a year between this financial year all the way to June 2028. So those are some of the flavors that you're saying. I think also in between we have payments to Trade Development Bank, something in the order of $1 billion thereabout that we should be paying.
Given how reliant Kenya has been on the Bretton Woods twins, right, the IMF and the World Bank, for a lot of concessional debt, you mentioned the $1.2 billion in a DPO loan that came in from the World Bank. They say that's one part of a 3-year program. The IMF has given us a fair bit of debt as well. Specifically with IMF, what happens next with Kenya's IMF program? Because that hasn't gone to board review yet. So what can be reasonably reviewed in terms of the performance targets agreed to under that program?
Well, that's the billion-dollar question, Rama. And remember, this specific seventh review has been here with us for like 3 months. It started the first 2 weeks in April, and then there's the spring meetings. Then they came in right before we went to plant trees, where we had that lengthy, like 1 month review. And last month, we eventually got the staff level agreement from the IMF. So all along, my thinking was that the only thing that is the hurdle that needs to be raised, that needs to be surpassed, is now the finance bill. But now that that was shelved off, we've seen that even the approval of the IMF program or the seventh disbursement has been sort of is still in a limbo somewhat. So that now takes us back to seventh review was actually looking at the data as of December last year. Tax revenue was missed, fiscal, the budget, the primary balance was somewhat hit somewhat. So all this is still hanging in the balance as and when we start seeing progress within the legislative track. This is basically passage of the supplementary appropriation bill, amendment to the Division of Revenue Act, and also what goes to counties. That will give us an indicator as to how the reviews will look like. So probably they might work with some guesstimates as it is right now, the 177 billion slash to counties and national governments for now, in the event that if there could be a near-term approval. But as it is, I think there's a layer of uncertainty as to when we can now be able to get disbursement from the IMF.